Hi, my name is Dr. Jamie Klingman. I am the founder of the Exit Strategy Company, and I am excited to get the smoke out of the way and help you understand what your business is really worth, as I wish I had when I sold my company years ago.
Hi, my name is Sam Martinez. I'm a business broker with the Exit Strategy Company. And I got into this business because I sold my business as well about 5 years ago. And now I get the privilege to help others exit from their businesses as well.
I thought today we could talk about, because we get questions about this a lot, what is EBITDA? What is SDE slash adjusted EBITDA?
I thought it was
All the
called
letters.
EBITDA
EBITDA,
or EBITDA or
EBITDA. Yes,
who
I've heard
is
that.
this EBITDA person,
Yes. And those lots of letters, and they mean different things to different people somehow. And so thought
which
we
is
could,
really strange because this is a very generally accepted accounting principles term, which means take it away, Jamie.
which, well, yeah, we didn't all, some of us didn't take accounting, right? Like not every person in the world took accounting. I did. Frankly, I did not love that class, but so EBITDA does generally have a very standardized meaning. Earnings before interest, taxes, depreciation, and amortization. So that is
Right.
our net profit, and we're gonna add back only interest, taxes, depreciation, and amortization. End of story.
Exactly. Exactly. And so it really is for those business owners who are running their businesses with actual software, financial software, which can I just kind of make a parenthesis and say, if you're not, you need to. You need to use QuickBooks or some other financial software or something that actually can, where you can pull up reports like your profit and loss statement, also known as the income statement, balance sheet, which shows how much assets to liabilities your business has. And every business, no matter if it's a service business or a product business, needs to have that. But in your income statement, your profit and loss, that's where you're going to find this EBITDA number, at least the EBIT number, and then the you add back later. So
And
with that,
yeah, and EBITDA is great for particularly businesses that are, they can be run by owner operators, but they tend to have grown to the point that they are being run as true corporations, and we're not having owners' expenses and other choices of expenses being added in. So that usually that number works for larger companies, and but it does not always reflect accurately the true value of a smaller, we'll say under 5 million owner operator business, where there may have been some expenses that qualify for IRS tax deductions, but are not necessarily needed to go forward in the business. And so to really show the true opportunity, you have to flush out what that number is. And that's the seller's discretionary earnings, literally the earnings that the seller is discretionarily using that qualify as business expenses. But if you did not make those expenses, the business could continue forth as it was. So the real easy way to think about that is always, is that an expense that if I stopped paying that today, would the business continue as it is? And that can be everything from a silent owner or an owner that's not actively participating, who's getting pay. That can be benefits to those owners, spouses, those types of things.
could be the salary of a spouse who's really not that involved in the business, but for tax purposes or 401k contributions, they added them. And so that's also known as adjusted EBITDA. So seller's discretionary earnings are adjusted EBITDA. And in this space, especially, I would say, I think you would agree, especially under the 10 million enterprise value space, it's pretty common that you're going to see SDE or adjusted EBITDA, and that's the number you want to focus on and hone in on.
Yes.
One quick question about that though, or one kind of big deal, is that as business owners, we're trying to take every deduction in the book for taxes, and that can be really detrimental to trying to sell a business. And so just because the IRS lets you take it, it doesn't mean you should always reflect that in your financials because that could really hurt you trying to sell your company in the future or get the maximum value for it.
And the biggest example I have of that is when you, as a seller, say that you've added money back into the business. So not talking about even because, automobiles, if they're not being used, unless you're in the delivery business, we can, that's an explainable, understandable expense that the IRS says is, but we know is not an expense going forward. One-time expenses, you invested in something that can be okay. But when you say that you have added money back to the business, that tax savings, we'll call it 35%, right? You saved on your taxes by taking that deduction. But and when you go to sell, that number, the full amount times the multiple is what you're missing out on in a sales price because of that. So when you're 2 to 3 years out from selling, be really cautious about taking those deductions because they cost tons to,
Way more than you think.
hundreds of percent more than what just paying the taxes on that amount would have been.
Awesome. All right. So next time we got to talk about why this is so important.